Hi Barrage, thanks for your question. I thought it'd be best to answer it with a screencast. What I've done is I've gone into AME and I brought up one of the post-class homeworks. This one is a little bit different than yours, but you'll probably get an idea of what the process is to do the calculations by this one. So on May the 1st, I think your question said June 1st. But this one says May 1st, 2016, London Fluid Power purchased equipment for $96,000. The equipment is expected to last 5 years and will have no residual value. London Fluid Power has a December 31st year end. So there's a lot of information in here. First thing is the original cost of the equipment. So they purchased equipment for $96,000. That is the original cost on May 21st, 2016. So $96,000, we can enter that in that box. But when you look at this column, original cost of the equipment for 2017, the original cost is still going to be $96,000. So what we can do is we can just carry that down, and I believe you did have that correct in your question. I always like to put that in just to eliminate having to add later on. So the equipment is expected to last 5 years. We see 2016, 2017, 2018, 2019, 2020. Okay, we have 5 years there. However, you notice that this was purchased on May the 1st, 2016, and London Fluid Power has a December 31st year end. So what that means is for the first year on the new start of the new year, January 1st, 2016, London Fluid Power didn't have this equipment. So they didn't have it until 5 months into 2016. So what we have to do is we have to calculate the depreciation for 7 months of 2016. So I think this is where yours, I think you had 0. But we did have some depreciation. So as soon as they bought the equipment, May the 1st, they started using it. So it would start depreciating right on May the 1st, 2016. So having said that, we have to take our 96,000 and we're going to divide it by 5 because we know it has 5 years for its depreciation. So that's $19,200. Now that means that's for 1 year. But we have 12 months in 1 year. So I divide that by 12. And I have $1,600 for 1 month. So what I've done is I've taken the 96,000, I've divided it by 5 because it has 5 years for depreciation it's expected to last. Then I'm calculating it monthly, and I have the 1,600. May the 1st is when we purchased the equipment, so it was used for May, June, July, August, September, October, November, and December with the December 31st year end. So that means there was another for May, June, July, August, September, October, November, December, 8 months. So for the full month of May, and then June, July, August, September, October, November, December. So 8 months of depreciation. So what I'm going to do is I'm going to take that monthly depreciation of $1,600 and I'm going to multiply that by 8 months. And I get a number of $12,800. Since this is the first year, or the first 8 months within the fiscal year, that will be our accumulated depreciation. So what we do is we find out that after 8 months of operation with that equipment from May the 1st, 2016 to December the 31st of 2016, that with the new fiscal year in 2017, our equipment is now worth $83,200. Our depreciation expense for the entire year of 2017 is going to be 12 months. So we can take that $1,600 on the monthly depreciation and multiply it by 12. So $19,200 will be the depreciation expense for the full year of 2017 that equipment is in operation with the business. So we now look at our accumulated depreciation. We take the $12,800 from 2016, add it to the $19,200 for 2017, and I have $12,800 plus the $19,200. That gives me $32,000. So with that being our accumulated depreciation, I find it's easiest just to go back to the original cost of the equipment and subtract the accumulated depreciation, which is $96,000 minus $32,000, which is $64,000. 2018, it's a full year, so it's $1,600 times 12. I'm just going to do that, make sure I had the right calculation. Yep, so $19,200, and we're going to take that and we're going to add it to our previous accumulated depreciation, so $32,000 plus $19,200 is $51,200. Again, I find it easier just to go back to our original cost of the equipment, $96,000, and subtract our new accumulated depreciation, $51,200. So at the end of 2018, December 31st, 2018, our equipment will be worth $44,800. In the year 2019, again, 12 months, so we still have our equipment in full use, depreciation $1,600 per month. So we have a depreciation expense for 2019 total of $19,200. We add that to our accumulated depreciation from the previous year, so $51,200 plus $19,200 equals $70,400. Again, going back to our original cost, $96,000, I subtract the accumulated depreciation for 2019, which is $70,400, gives me $25,600, and that's how much it's worth at the end of 2019. 2020, okay, we have a full year 2020. Again, each month is $1,600, 12 months in a year, so for the full year from January 1st to December 31st of 2020, it's going to be $19,200. And our accumulated depreciation, we take the depreciation for 2020, we add it to the accumulated depreciation from 2019, and I get a number of $89,600. So I take my original cost of the equipment, $96,000, I subtract $89,600, and that means on December the 31st of 2020, our net book value is $6,400. And what will happen is up until 2021, so May 1st, 2021 is when it will be worth zero. So we have to remember that we have to shift that time. Since we purchased the equipment in May of a year, that it's going to not be at the end of the year it's going to be worth zero. There's still going to be some left. So that's where you do that calculation. I hope that makes sense. If you need clarification, please feel free to email me. Thank you. I hope this helped. Take care. And I should have just added, let's do a quick check. And there we go, it's all right. So, Take care. Have a good afternoon. Let me know how you make out.